Rita for inviting me here, mainly because it forced me to go through the Tax Act provision by provision, which was what I did. And now, you know, I'm an economist, so I'm used to being the skunk at the party. And now I'm going to give you the facts about this tax bill. Now, the Tax Act has hundreds of changes in the individual and corporate code, and looking at all of them in a period of historically high and divisive inequality, its dramatic reduction in the long-term tax burden on the richest Americans, I consider a calamity. But focusing just on the impact of the corporate changes on investment and trade, it's not a calamity. It's just a mess. Now, don't be surprised. The 1986 Tax Act took 2 years and 40 hearings of analysis and revisions before it was produced. This one was done in 7 weeks with no hearings. Devote such glancing attention to deeply complex areas of tax and economics, and a mess is inevitable. There are 3 major issues to think through regarding the Act's effects on investment and trade. I'll start with the best one. The Act broadens bonus depreciation of corporate assets and increases it to 100%, which means expensing, while reducing the deduction for interest on loans used to finance the depreciating asset. This simplifies the code and makes investment more efficient. In fact, I privately urged the chairman of the Council of Economic Advisors to build the whole bill around expensing. Alas, they even turned this into a mess, because the new expensing only holds until 2022, and then it phases out over 4 years. So it ends up economically shifting some planned investments forward with little effect on long-term investment rates. That's what economists have found with temporary provisions like this. Moreover, the Act also ends the expensing of research and experimental costs, which Ed mentioned, including software development, very dynamic sector, and subjects those costs to amortization. Doing that raises nearly 50% more revenues that are given up by the expansion of bonus depreciation. So the negative effect on investment from the R&E change will outweigh the positive economic effect on investment from temporary expensing. That's what the numbers say. Beyond that, the sharp reduction in the marginal rate to 21% reduces the impact of even temporary expensing. Its overall effect on trade and investment at best will be marginal. It's a mess. The next big change to think through is the shift from the worldwide tax regime to what I call a hybrid territorial one. Under the new Act, a U.S. company can claim 100% deduction for foreign source dividends. That's how multinationals transfer profits from foreign subsidiaries and from other foreign companies that in which they own at least 10% of them. Here too, the low tax rate blunts the benefits of the shift to territoriality. In fact, at a 21% tax rate, most foreign source profits wouldn't be subject to U.S. tax under the old worldwide system, since most of the U.S. FDI generating these profits are located in places with tax rates equal or higher than that. That is, I did an analysis of where all U.S. foreign direct investment stocks are, and I looked at the tax rates in those countries relative to their share of FDI. The FDI is what's generating all this foreign source income. And the average tax rate weighted for the amount of FDI was about 21 to 22%. So you didn't need territoriality with respect to its impact on investment and trade. Now, the administration insists that the lower rate will induce companies to shift investment from abroad back to the U.S. Again, their economic reasoning is dubious. 2 decades of economic analysis of foreign direct investment flows have shown that relative tax rates play very little role in where companies locate their FDI. Yes, to begin, they consider the price of all factors affecting their businesses. Yes, relative taxes, but also the relative costs of land, labor, equipment, transportation, and energy. And the largest factors aren't economic at all, they're political. Does the rule of law apply? Are contracts and intellectual property rights respected? Or most important of all, where are the markets of those companies? That's where they cite their FDI. No one is going to shift their direct investment to serve the Indian market from Mumbai to Minneapolis, or direct investments to serve European consumers from Milan or Madrid to Milwaukee, because the US corporate rate has fallen. And even if tax rates had larger effects on FDI, which economically we know they don't, despite the 35% rate, the effective tax burden on US corporations was already 20%, which is lower than the average for OECD countries. I'm talking about the federal burden. Does this mean that the new territorial system then will encourage US companies to shift investment in the other direction, from the US to overseas, and which you sometimes hear from members of my party? Again, the answer is no. The factors just cited play the decisive role. So the Act's authors needn't have worried so much about it. But alas, they did. And the result is another mess. Real territoriality would have simplified the code and improved the efficiency of investment. They weren't satisfied with that. So they concocted a complex and very messy hybrid system. First, it deems all foreign source profits held abroad since 1986 as repatriated, and taxed at a 15.5% rate for cash and an 8% rate for everything else, with only a partial credit, incidentally, for foreign taxes already paid on those funds. Only a partial one, which makes it worse than the previous regime. It also deems as repatriated dividends all profits earned from intangible assets. Now there they're targeting royalties on software and pharmaceuticals, and taxes them at half the US corporate rate. Next, it imposes a 10% global minimum tax on future foreign source profits. So if a US firm pays less than a 10% tax on its foreign profits to a foreign government, say by parking assets in Bermuda or Liechtenstein, it will be subject to a 10% US tax. That's not a bad thing from my point of view, but it's another complication for what could have been a clean territorial system. There's also a 10% tax on intra-firm transfers, where the US parent, and Ed spoke of this, I think of it mainly where the US parent buys services from a wholly or partly owned foreign company, so it can in effect shift taxable US profits abroad. That's the aim, to discourage companies from doing it. That's also not a bad thing. But again, it forgoes the simplification and economic efficiencies associated with territoriality in favor of another mess. The next logical question is whether the 21% rate will convince foreign corporations to invest more here. The fact is, with a 35% corporate rate, the US has attracted more foreign direct investment than any other country in the world for all the reasons I cited before. They apply just as much to foreign corporations where they cite their FDI as they apply to US corporations where they cite their FDI. Could it have some marginal additional benefit? Perhaps, but not much of one. Again, while the marginal corporate rate was 35%, the effective corporate rate in 2016 was 20%. So any new benefit for foreign corporations investing here will at best be marginal and modest. The third issue to think about here is how the Tax Act affects the economic environment for investment and trade. Here we find another big mess. Apart from the short-lived investment incentive from temporary expensing, the Act penalizes our most globally competitive industries, those that produce and depend most on new intellectual property. It also doesn't do much for traditional manufacturing, since the only real reform in the Act is the repeal of the sloppy tax deductions in Section 199, which is aimed at manufacturing. The Act also does nothing to spur innovation, our principal advantage in global markets, the source of much of our investment, and the leading edge of all U.S. exports. What the Act will do to the environment for investment is increase the budget deficit by an average of $150 billion per year, and since all of that has to be borrowed from U.S. or foreign lenders, put upward pressure on interest rates. Higher rates reduce investment directly, since they increase the cost, and indirectly, since they dampen the demand that spurs investment. In fact, U.S. fixed investment, business investment, increased by $103 billion in 2017, which is $50 billion less than the increase in borrowing to fund this mess, so the Tax Act could actually depress U.S. investment. Turning to the dollar, the Tax Act at a minimum hasn't increased confidence in the U.S. economy abroad. Since it passed, the dollar is down 2% against the euro, 3% against the yen, and 4% against the Swiss franc. So there's been no rush by foreign companies to invest here, since doing so requires dollars, which increase its exchange rate value. Now, a weaker dollar should spur our exports, but financing this turkey will put upward pressure on the dollar, since we'll have to offer higher returns to attract the additional $150 billion a year in loans. So my final verdict, again, is what a mess.